In this video, we're going to conclude our discussions about dividend policy and distributions to shareholders. So how do we set the policy, right? So first of all, we need to have some idea of the future, right? We have to predict or forecast. What are we going to need to spend money on from a capital asset perspective? Maybe we need 5 years or more to do that. We need to have some understanding of what we want our capital structure to look like. From there, we can estimate our annual equity needs. We can maybe set a target payout ratio based on the residual model. And in general, maybe, we can set some kind of a dividend growth rate expectations, right? So maybe we want to maintain this growth rate if possible, just so that we can continue to provide some level of return to our owners. So let's talk about some different kinds of plans that are possible, right? The first one we can talk about is something called a dividend reinvestment plan. This is where shareholders will have their dividends automatically reinvested into the company's common stock. Many companies offer this alternative. So instead of receiving the cash, you receive more shares. There's two ways that this works, but before we get there, let's think about this. You get more stock. So this is a form of reinvestment. So you are going to get a compound return on your money. However, you do have to remember that there will be a tax, right? You are receiving a dividend, and that is taxable. So you won't receive any cash, but a dividend or a tax rate is required. Now, there are two ways that this plan works: through open market or through a new stock plan. So let's review these. Essentially, what happens in an open market plan is that the money that was going to be dollars are going to be reinvested are turned over to a trustee, right? So these dollars, the dividend itself essentially is given to a trustee. The trustee goes out and buys shares on the open market. This should minimize some brokerage costs because the volume is going to have a lower brokerage cost. And of course, it's an easy way to invest. And it's kind of convenient, at the very least, for investors. Now, a new stock plan basically is the firm issues new stock to these DRIP enrollees, right? Usually at a discount. It keeps money and uses it to buy assets. So in this case, the firms that need new equity capital use these new stock plans because the cash that was supposed to be spent is actually kept, and they issue new stock in its place. If you don't need new capital, you might not want to utilize this particular plan. So the companies that are in the New York Stock Exchange that have one of these DRIPs, right? I mean, they're very useful for investors, and they're very frequent. I mean, sometimes a strategy, maybe a grandparent, buys a share of stock in Disney for their grandchild. They only want to buy one stock, so they create an account through a DRIP program. So that this stock now, you can buy one stock, it's relatively cheap, and the process obviously goes on. Of course, there's a compounding that can happen when dividends are ultimately paid. Stock dividends versus stock splits is another form of distribution, but it's different, right? Cash is cash. You're either going to receive cash in the form of cash itself, or you're going to receive stock based on how many shares of stock you have. Now, stock dividends and stock splits are slightly different. There's really no cash distribution at all, right? You are going to receive either a set number percentage of shares, or you're going to receive a percentage. So a stock dividend is when a firm issues new shares instead of paying a cash dividend. So if it's 10%, you'll get 10 shares for each 100 shares you own. But there's no specific cash distribution by the company. In a stock split, the firm increases the number of shares outstanding. Their example here is 2 to 1. So what they will do is they'll send a letter to shareholders saying, please send us your shares. For every 1 share you send us, we will send you 2 in return. So stock splits and dividends are very popular. Now, what's the difference between the two? The difference between the two is really how they are accounted for, right? This is just a way of altering the common equity section of the balance sheet. The numbers are going to be jumbled around. Nothing really happens, right? So what happens if you kind of think of equity as being a pie, the pie is just divided into smaller pieces. If you owned 50% before the split, you're still going to own 50% after the split. Now, so if nothing happens, why would companies do this? Lots of reasons. Number one is they may want to provide some information, right? So if they do a split and then maybe increase dividends, that may be a very important signal to investors, right? That, hey, things are really going to be good in the future. We're going to pay a little bit higher in dividends. And because now you have more shares, you're actually going to get more of that. There may also be some indication that companies try to get their price in what they refer to as an optimal price range. Now, right off the bat, this kind of sounds like manipulation. They're manipulating the price. But this is purely for a market-based purpose, right? They want people to see their company, analyze their company, hopefully buy their company stock. They want their stock to be in demand. For it to be in demand, people have to be willing to pay attention to it. The theory is that this happens typically in a range between $20 and $70. If a stock has a price between $20 and $70, most people see that as a buyable option, right? They can afford it. If the stock price is at $150, $200, $300, they can't afford that, right? So it's not an option for them to invest in. Why should they even pay attention to the company? If it's less than 20, if it's $5 or $6 per share, it doesn't seem like it's that, in quotes, important. So why would anybody pay time, money, and effort, right, to understand and analyze those companies when they seem too small? So again, the idea here is that if we can get our stock price in a particular range, more people are interested in it. So they mentioned here that it seems that in recent years, companies don't seem to be splitting stock as frequently. Again, how that works is I think is a function of time. But there are many companies who do this very often. One company that seems to be, at least over time, kind of be a poster child for stock splits is P&G. every time P&G stock seems to get around $130, $140, $150, you can pretty much think historically that that stock now becomes that company will undergo a stock split because it wants the stock to be available for everybody. Another kind of distribution is what we refer to as stock repurchases. We've mentioned them before. This is when a company buys back its stock from its shareholders. This is an alternative to distributing cash, but you're still giving cash, right? In the end, you're going to make a large capital structure change. This is part of the purpose here. We are actually reducing the equity section of the company by paying cash, reducing the number of stocks that are outstanding. This stock now becomes what we refer to as treasury stock. One of the purposes for this can be for options for employees. It also could be to stockpile shares for an eventual purchase of another company. So you could use those shares to purchase other companies. So what are the advantages of repurchases? Stockholders can decide to sell back or not. They can make that decision. It avoids higher dividends if you can't maintain them, right? Repurchases, again mentioned, can be used in takeovers. It can eventually, if the stock price goes back up or rises, you can sell it back to the public. Again, if you think that for some reason they refer to this of a large block of stock overhanging the market, there's just so much stock out there, it's keeping the stock price down. You want to reduce the supply. And again, stockholders could take this as a positive signal that management thinks the stock is undervalued. What are the disadvantages? It could be viewed as a negative signal, right? Firms that have poor investment opportunities, right? They have no growth opportunities, so they buy back the stock instead of paying out the dividends. The IRS can impose penalties if the idea of this repurchase is to avoid taxes on dividends. Now, I'm a little confused about that statement because if you sell your stock back, you are going to pay capital gains taxes. So capital gains taxes and dividend taxes are paid regardless. The selling stockholders, right? If you sell this stock, you might not be very well informed, right? Why would you sell your stock back, right? So these stockholders that sell their stock back might ultimately feel like they've been treated unfairly. And again, the firm may have to sell at a higher price, right? People don't want to sell back. So maybe they have to, the repurchase is actually at a premium. So they might have to pay a premium to buy back their own stock. So there's lots of connecting dots when we think about dividend policy. As investors, we have a tendency not to think about any of this chapter. We think about dividends as that thing we receive when we buy stocks. This chapter is all about, or these videos are all about, how does management decide what to pay, if to pay, when to pay, right? That's what these videos have been all about. So I hope you enjoyed the videos. I look forward to seeing you next time.